Welcome back, everybody. Today we're going to be talking about one of the best option strategies for new traders, and that's called the wheel strategy. Some people like to call it the no loss strategy or the triple income strategy. We're going to go over why they give them those variations of names. But basically, this strategy is really good for beginners because it doesn't require too much knowledge about options in order to implement while you're still learning the basics. But by the time you're done with this video, you should understand exactly how you can run the wheel option strategy in your account and even do it if you're a dividend investor. So the very basic thing about the wheel is that it's very easy to implement because the decisions you make are pretty much predetermined. So if you've never seen a flowchart before, what you need to know is that when you see a diamond shape, that's basically a question that you have to answer. It's a yes or no question, and depending on what you answer, will dictate the next move that you make. So first, you sell a cash secured put, and don't worry, we'll get into what that is later in this video. And then you come up with the question, did it expire out of the money? Now this means, did it expire worthless? If it did, awesome. So if the answer is yes, then congratulations, you made money, and then you go back and you sell a cash secured put. So let's do the second version now. So let's say you sold a cash secured put, and this time you asked, did it expire out of the money? The answer is no, because it expired in the money. So the next thing you have to do is ask yourself, is it above your stock break-even price? So you sold some premium, and then let's say you got $5 credit and you sold it on a $10 stock, and the stock's trading at $7.50. Well, your break even would be $5 because it's 10 minus the $5 that you got for premium, and it being at $7.50, it would be above. So if that's the case, congratulations. You can just immediately sell the 100 shares, and you still come out ahead by $250 because the difference between that $7.50 and $5 is $2.50. So again, congratulations, you made money and you're back to step one. Another version is that you go ahead and you sell your cash secured put. It expires in the money. The stock is not above your break even, so the answer is no now. So we come down here, and now you're in the part that most people consider to be the entire wheel, but it's not. The best part of the wheel is what we just talked about. But when you get to this point, this is where you lost on that put that you sold. And what you do is you sell a covered call at break even. This is you saying, I'll give up these 100 shares at this price. For doing that, you get a premium, which lowers your cost basis overall. And so you do this, and you come over here, now you have another question. And it says, did you expire in the money? If the answer is no, what you do is you just come right back here, and you sell another covered call at break even price, collect that premium, and you come back here again to expire in the money. And this can go on and on and on and on until it finally does expire in the money. And then when that happens, congratulations, you still come out with a profit, and you're back to phase one, and you're selling a cash secured put. That's the entire wheel strategy in a nutshell. But we're going to go ahead and break down what selling a put is, what selling a covered call is, go over some examples, and by the end of this video, this chart, when you just look at it from the get-go, will make a lot more sense if it doesn't already. So the first step of the wheel is that you sell a cash secured put. And what that means is that you have enough money to buy 100 shares at a certain price. Now, I'm going to go ahead and set up Robinhood to show as though we were selling a put. And typically, what you would be doing is selling like a month out. That's what most people recommend. So I'm just go ahead and select April 14th. So that'd be like a month out. Now, if we look at the current price up here, it's 108. Now, as the seller of the option, I can dictate what price I'll be willing to pay to pick up the shares. So say AMD, I'm fine with owning at $100. What I can do is I'll end up choosing this option here. And what that's saying is I'm willing to buy 100 shares at $100 each. And then for doing that, the buyer of the option contract is saying he's going to pay me $5.38. But remember, that's per share. What he's going to be doing is paying you $5.38 per share. So you multiply this by 100, and that becomes $538. So by saying that you will buy 100 shares of AMD, if AMD goes below 100, they're going to give you $538 for making that promise. Now, you may have noticed I said cash secured puts a couple times. All right, so I mentioned you're going to be selling a cash secured put. And sometimes people will list that as CSP, cash secured put. So if you ever see it as CSP, that's what that is. And all this means is that you have the cash in your account to pick up the 100 shares that you promised to buy. So in this example, we said AMD 100. So multiply 100 by 100. What you would need to secure this would be $10,000. If you don't have $10,000 in your account, then it's called a naked put. And that's more of an advanced strategy, but you don't have to worry about that right now. With the wheel, you're running as though you're going to be picking up the shares if it does go down, because that's kind of the whole plan of the wheel is if you get put the shares, you turn around and you sell the covered calls. So the first step is that you want to have the cash for the strike price that you choose. So even though AMD is at 108 right now, you can sell this option and be cash secured because you're selling the $100 and not the 108 area. When people sell an option, they either say that they sold the put or that they wrote the option contract. So write and sell are two of the same things. So if you see it either way, that's how that works. So when you look at the option contract that we sold, what we sold was the AMD $100 April, I think it was the 18th contract. That's how it gets written out. So the main part to see is that A, you have your stock tier. B, this is the strike price. This is what you promised to buy the shares at. So that's the strike price. And then the last thing that you see when you look at the contract is the date of expiration. What happens is when AMD gets to this day and market closes, if the price of AMD is above 100, your option will expire worthless. So let's say AMD goes up to $110. The reason why it's going to expire worthless is because the buyer would rather sell the shares to the market at $110 instead of selling it to you for $100. I mean, if they want to give it to you and exercise even though they're out of the money, that's awesome. Thank you for the free money. But that's not going to happen. So if the price stays above your strike price when you're selling a put, they're not going to put the shares to you. You're not going to have to buy 100 shares. All that happened is that you keep that $534 or whatever it was, and you can use that to go buy whatever stocks or go buy lunch. That's money that you keep. So now when you're looking at this, I hope this makes a little bit more sense about what's going on. We sold a put that expires on this date. If the stock price is above our strike price at that time, then that's money that we keep. We don't have to do anything. We kept our end of our promise. We said we'd buy 100 shares. If it went below 100, it did not. So thank you for the money. It kind of feels like you just sold them like a bag of paper air and said, don't open it for a month and you might have a nice little prize in there at the end. And it turns out that there's nothing in there. That's what it feels like. It just feels like you're just selling them promises. It's awesome. The premium you got, just multiply that by 100. So that's $538 cash that went into your account. You can turn around and start using that money the day you sell this option contract. Although some people will say to hold on to it because you can use it to manage your position. If you're running the wheel strategy, it doesn't really matter because you're already set up to buy 100 shares, worst case scenario on this play. Now, I say that's the worst case scenario, but if the stock price goes down to zero, guess what? You're still buying those shares at $100. So that's the flip side of this, is that you still have to buy those shares at 100. Now, had you bought the shares today at 108, you'd have a $10,800 loss versus only a $10,000 loss minus the $538, so a little bit less than $10,000. So that's the benefit of using options. It's a little bit, you can manage your risk a lot more. So anyway, I'm going to go ahead and click on the actual play here so you can see what the P&L looks like on Robinhood. And again, this graph that we see here should make a lot of sense because we just kind of went over what happens. So this price here, we get max profit on the option if it stays above 100. So we know that this point here is 100. We're collecting 538. So then this point here where we start to lose money is 100 minus 538. So that's how you can just see that this is actually working out the way that I just explained it. If the stock price stays above 100, great, we made money. If it goes below 104.62, I think that is, then that's when we're losing money and we'll be going into the lower end of the wheel. If it's anywhere in between here, we can just turn around, sell the shares, whatever price it's at, and then we could just sell another cash secured put. All right, so the next thing I want to point out when you're looking at the option chain, because the next question is, how do you determine what level you want to sell the strike at? And the first question you should ask yourself, would be what price would I be willing to buy the stock at? That's going to help dictate where you're going to put your strike price at. Another thing you might want to start looking at, even if it doesn't influence your decisions early on, would be the chance of profit. And for this 100 one, it's at 69.9%. So I know that the delta is about 0.3. If we scroll down, even this shows 31 delta. Now for people that do advanced strategies, 30 delta is kind of like the limit for a majority of people of how far or how close they want to be. Anything above that tends to be considered very risky. But when you're running the wheel strategy and you're actually willing to buy the shares of the stock at that price, then it's not as aggressive. If you're willing to buy the shares at 110, what you could do is go ahead and sell the 110 one, and then you get an extra, $440 for doing that. And this would be something that you would do if you're very bullish on the stock. So it's trading at 108 right now, and you're saying, I know it's going to go up, and I'm fine with buying it at 110. You can sell an in-the-money put. You get a bigger premium for doing that. Your break-even for your shares or your cost basis would be the 110 minus the premium received. So if you do get put shares, you're actually buying it at 110, but you collected 978. So your cost basis would be 122 cents, I think that comes out to be, which is still lower than the price here. So to sum that part up, and I hope that didn't sound too complicated, if you're willing to buy 100 shares of any stock and it has option chains at the current price, turn around and sell a put, you'd still get the shares at that price most likely, but you lower your cost basis significantly by selling the option to get into the position. So even if you're not running the wheel strategy, you can turn around and use it to lower your cost basis on anything that you will be buying normally. So great way to enter some positions. I think one more thing I need to note right here is that for taxes, this is treated as ordinary income. So it's taxed at your normal income rate. It's no long-term capital gains taxes or anything like that. It's ordinary income. So take that into account when you're doing your options if it's something that you worry about. All right, so we talked about selling puts. The other part that you need to know in order to do the wheel is to sell a covered call. So a covered call is just you saying, I'm willing to give you 100 shares at this price on this date if the stock price above the strike price. So it's just the opposite. For puts, you're buying 100 shares if it goes below your strike price. For calls, you're giving 100 shares if it goes above that price. If you just sold a call and you didn't own the shares, you'd have to go to the market and buy 100 shares at whatever price it is now and sell it to that person at the price that you chose. So if you sold a $105 call on a stock and the stock shot up to 200, you have to go to the market, buy 100 shares at 200, which would be $20,000, and immediately sell them for 105, which would be $10,500. That's not fun. But with covered calls, you don't have that risk of the stock running up, causing you major losses. You already own the 100 shares, so they would just take the 100 shares from your account and give them to the buyer of the option if he exercises it. So a covered call, you own 100 shares, and that's your collateral for this. So for this example, we're going to say that we sold a call on AMD at 105 for April 18th, I think I chose. And for doing that, we're going to get paid $8.10 in premium. Now what this means is that if AMD is above 105 at expiration, we give up the shares that we got. Perhaps we got put at $100 and we chose to sell the 105. So we bought them for 100. We said we're okay with selling these shares at 105. And for doing that promise, we get paid $810 because remember, this is times 100 because you're doing this on 100 shares. Now, what I just said is that we bought them at $100 each. So the difference between this to 105 is $5. So you also get that capital gains on your stocks for them appreciating because we sold a cover call above our cost basis in this example, which means not only do we collect $810 here, we collect another $500 when we sold the call. And this is why some people start to call it like the triple income strategy, because even during this time, if there's a dividend that gets paid out, you get that dividend if you still own the shares. Now, you do run the risk if the extrinsic value of the option gets too little and the dividend's coming up, someone might take away your shares early in order to capture the dividend. But we're not going to worry about that too much because you don't really care about the dividend. That's just an extra bonus in this example. And When they do that, you still get to keep the $810, which is usually more than whatever the dividend would be anyway. Now let's go ahead and jump into Robinhood and take a look at what all this looks like. All right, so now we're on Robinhood, and what I did is I went to sell call. Now we're pretending that we got this for $100, and we sold the 105 strike. So we're saying that we'll give you 100 shares, but you're paying me $105 per share. And for making this promise, you're giving me some premium, and in this case, it's actually more than I said originally. So it's $10.73 or $1,073 for saying that if AMD goes up, we're fine with you taking the shares from us for a profit. And for doing this, you're going to give me even more money. So that's pretty cool. That's what covered calls are. It's just a promise to sell your shares at a price on expiration. And if that's above your cost basis, that's just you saying, I'm willing to take my profit in this stock position at that time. And for doing that, you're also going to give me more money because we made this promise like a month ago. Now in this one, you can see that the P&L graph looks a little different. As it goes up, you lose money. But because you own the shares, that's not the case. It'll just be a straight line because you already own the shares, so you'll be giving up the shares that you already own. If you didn't own the shares, you have to buy it at whatever price the current price is for the stock price. And that's going to be a lot higher than you're going to be selling the shares for. So that's why that's negative. But then on the other hand, on this side, your covered call would be at max profit. But don't forget, you own the shares. So as the stock price goes down, you will be losing, but that's because you own stock in the position. The other thing that I want to point out is that your cost basis for the shares that you already own goes down significantly because you got that premium that you can like roll into the adjusted cost basis. So the last thing that you might want to think about when you're about to sell your cover call is what strike price you want to sell them at. So if you're feeling very bullish on the position, you could sell above your cost basis and then you get that stock appreciation gain. If you are feeling bearish about the position, you want to sell at the money, or some people would like to sell at the adjusted cost basis. They take the premium that they already collected on the stock, subtract it from their cost basis, and sell at that price. For doing that, you get a larger premium, but I like to do at the assigned price, or maybe assigned price minus one cycle of premium. So if we got assigned at 100, we could sell an option for $1,383 or $1,383. If we thought AMD might go up and we might participate in some of that run beyond 100, that's when you can move up a strike or two and you can sell the 105. You get less premium, but you end up making more from the difference between your strike prices. So if our cost base is 100 and we sell at 105, that's $500. Add the 1,073, that's more than selling at the money with just the premium alone. But you're on the risk of it not going in the money and you still have to hold the shares. So if you only want to go further up the chain when you sell the cover call, if you really don't mind owning the stock long term. Now, if you think the stock might drop, you may want to consider just selling the shares and starting back over from selling a cash secure put, or stick with selling at your cost basis of your shares, even if the premium might be a little bit less. Another thing that you should know when you're looking at this is that the premium in contracts goes up significantly as you go out in time. So now if we go look at the 105, it's up to 14.18. If we go another 2 weeks out, 105 is up to 16.83. So the longer out in time you go, and that you're willing to hold the shares, premium will go up and you make more money for selling that contract. But a majority of people do 30 to 45 days because that's when a thing called theta kicks in a lot more. And theta decays to make option prices their intrinsic value, which just means the actual worth of the contract. And out of the money calls, all that means is out of the money calls just run to zero really quickly. And it does that quicker as the expiration date comes. So stick to 30 to 45 days out is what a majority of people do. If you need to sell further out of the money calls to stay above your cost basis, then you might start going out in time so that you collect a decent premium to do so. So you're still making money on that position. It just might take longer. And luckily, though, you get to collect the dividends along the way. All right, so now I hope looking at this makes a lot more sense. And I want to talk about why some people call it the no-lose strategy or the never-lose strategy. And that's because if the worst-case scenario is that you own 100 shares of a stock that you wouldn't mind holding long-term, those shares might go down in price, and that's your biggest risk, is that you own those shares even if the stock price goes down. But if you're a long-term investor, that should be something that you're okay with. So that's the worst case scenario. And every other thing that happens with the options should turn out in an overall net profit. And as we look through this again, so if you sell a cash secured put and the stock price stays above that, then you know you already made money. You have to do nothing, and you just sell your next cash secured put. If it didn't expire out of the money, then you do have to buy 100 shares at that price. So that's where this no comes from. And again, the next question is the stock above your break even? If it is, then you just sell the shares. You make money less than what you collected for the premium that you sold it for, but you still made money, and you're in profit zone again. If not, now you're at that part where you're selling the covered calls. So you sell a covered call at break even price, or your assigned price, your put price. So if you sold a $100 put, then you sell a covered call at $100. But you do have the freedom to move up or down in price. Just know that if you move down, so if you sell a $95 covered call, you're locking in a $500 loss on the shares themselves. Even if your options would be positive, you're locking in a $500 loss there. There may be times that you will see that because of extrinsic value, that could be a profitable situation anyway. But for the basic learner right now, just sell at your assigned price, which would be $100 on the example that we've been doing. And you just do that every month until it eventually expires out of the money. And that's because you can just keep selling the covered call because your shares, you still own 100 shares. So this will be the stuff that you're just always in until it finishes in the money and your shares get called away or you have to give someone else your 100 shares. But once that happens, if you always sold above your cost basis, then again, there's just no way to lose on this aside from the fact that if the stock goes down, way down, then you lose on the shares themselves. But if you're holding stock anyway, you still have that same risk. So that's why people call this the never lose strategy. And when you're in this part of the wheel, you also get to collect your dividends until you get out. So that's why a lot of people love running their wheel in here. Now, more advanced traders will like to stay on the no assignment thing. So an example is for me, what I would do is I would sell a cash secured put. If it expires in the money, I would roll the position. I made a video about that. You can check that by checking this link here. And basically what I'm doing is I'm paying more money out than I receive to close the position. And then I just sell a new cash secured put. So this is where I tend to be on for myself, is in this area. Although a lot of people only talk about being in this area. Some people even go and buy 100 shares just to start at this point. But I just feel like that's kind of useless. Like, you can start by selling the put and have your cash working in some low, safe, interest yielding thing so that you still make money on that while you're doing it. Because you get the same premium, essentially, if you're running up here or down here. It's just this up here is more cash efficient. But that's a more advanced strategy. Just don't think you need to buy 100 shares to start down here. You can start by selling the put, which is what I think a majority of people that teach the wheel don't talk about. And this is really what I think the big wheel is. It's just a lot easier to talk about one little thing, and it makes a nice little circle so everyone's like, that's the entire wheel. It's a part of the wheel. There's a bigger wheel in play, but that's basically what this is. Anyway, I hope you guys enjoyed this. If you did, go ahead, like and subscribe and share it because I would love to see this channel grow. And if you learn something, pass that on.